Okay, welcome back everyone to the Quantitative Investing Festival 2021. We are in our second week of the festival today, and very happy to see all of you here with us as we come together once again to come and learn about a very different form of investing called quantitative investing. Right, so for those of you who are here with us for the first time, I'm Da Wei from iFast Global Markets. Right, and I run investment advisory for clients using the iFast platform. I help to manage investment portfolios and trusted to us to be grown over time over the next 20, 30, 40 over years. And I'm so glad to be your host and facilitator for today. Okay. So throughout the last week, we've had 4 sessions where we talked about hedge funds, right? We talked about risk and return, right? We went through what quant investing is, how it is very different from what we usually see and do about in the investor retail market, right? And on our third day, we also talked about how we can navigate the markets with clarity as investors in an information age, right? And on Saturday, most recently, just 3 days ago, everyone, we had a chance to hear on what volatility is and how we should and should not use them in our portfolio. Okay, so today we are going to start to move towards application, right, through our topic today called the all-weather strategy. And I know that some of you guys, right, when you read this title, you may have went, all-weather? Really? Right? Is it really all-weather in a sense that we are going to be able to do well for our investments no matter what happens in the market? Right? And so today we have once again our educational partner Allquant with us, from which we have Mr. Lim Eng Guan on board to share on the all-weather strategy, right? And later, Mr. Patrick Lim will also be joining us to answer some of your questions. Any questions that you have at the end of this session, they will be here to help you with it. Okay, so without further ado, right, let me pass the time over to Eng Guan. Right, Eng Guan, maybe could you introduce yourself first for the benefit of those who are here with us for the first time, and then please feel free to go straight into your topic as well.
Okay, yeah, sure. Thank you, Da Wei. Okay, for those who do not know me or your first time attending the webinar itself, so just let me do a very quick introduction of myself. My name is Eng Guan. Okay, I'm one of the partners in Allquant. So Allquant, we are a company that specializes in educating retail investors in the ways of quantitative approaches to investing. And these are usually not your typical strategies like stock picking, value investing kind of strategies. So these are more non-conventional or non-traditional strategies that we adapted from hedge funds that we used to run ourselves. Okay, and aside from that, Allquant, we also actively work with other people in the industry, be it in a way of education or promoting more investing options for the everyday investors. Okay, just like what we're doing with iFast Global Markets today. All right. And before I started Allquant, right, I spent like about 15 years of my career across like asset management, banking, and hedge funds. I first started off as an investment associate in our sovereign wealth fund here in Singapore, which is GIC. And back there, I was part of the team, right, that was responsible for conducting investment due diligence on hedge funds, okay, for the purpose of course, allocating money to them. And after my stint there, I moved over to investment banks, namely Credit Suisse and Barclays. And back at the banks, right, I did something a little bit different. So I was looking after valuation control matters regarding like complex structured trades that the banks actually do with their institutional clients. Okay, and after that, then I left the banks and I moved on into prop trading for a couple of years where I traded like interest rate futures spreads and some other stuff. So that lasted a couple of years before I eventually joined a local-based hedge fund called Liquid Value Asset Management. And over there, I was co-managing a multi-strategy fund together with my business partner, Patrick, who's going to come in later as well. And back at the fund, right, we utilized a multi-strategy approach, which we adapted and yet we're using for Allquant today. Okay, so this is in a nutshell my background. Okay, so what I'm going to do next, right, over the next like 30 or 35 minutes, what I'm going to touch on the all-weather strategy, and I'm going to introduce to you how it actually works. Okay, so bear with me while I set up the slides. Okay, so my screen all right, Tawi?
Yes, all good.
Okay, cool. All right, so let's proceed on, right? So, okay, I'm just kicking off this session today, right, with a very fundamental question here. Okay, just ask yourself, right, how do you want to grow your wealth? Okay, this may seem like a very basic question, but I will not be surprised if some of you are scratching your head here, right? Because maybe you haven't really given it a serious thought yet. Okay, but at the very least, I think we can agree on this. That is, we all want to grow our wealth. And the broader question here is how, right? Because we don't just want to kind of like aim to get there and then invest in a couple of things and hope that we eventually get there. Okay, because in all the things we do, right, and not just investing, if we want to maximize our chance of success, we are going to need a plan and we are going to need a strategy. All right. Okay, now imagine the scenario here, right, where you have $100,000 to invest, right, and your end goal here is to actually kind of reach $1 million, right, for the purpose, let's say, retirement. So in a wishful way, right, I think everyone will hope that they can grow this $100,000 steadily in a straight line, right, and such as your portfolio growing like every single day, right, and eventually hit the $1 million when the time comes. Okay, but we all know this is a fantasy scenario, right? In reality, this is not going to happen. So what happens is that a lot of people will invest in something they believe, right, that can get them there as fast as possible. So as a result, most people ended up investing in stocks or predominantly in stocks, and for good reasons, right? Because stocks are readily accessible, they are intuitive to understand as an asset class, they have potentially higher long-term return, and there is actually no lack of like news, media coverage, or information, right? Everyone is talking about stocks. So all these mixed stocks look like a lot more exciting and sexy, you know, as an investment. So what happens is that a good number of people may just invest like 100% or the bulk of their wealth or their capital in the stocks, and then they wait for the investments to grow to a sizable amount. Okay, and they have this notion that as long as you hold it for the long term, things are going to be all right. Okay, but there is an important issue, right, with this approach. Okay, I've shown this before in my previous webinar as well. So stocks have one of the highest return among all the asset class, yes. Okay, but at the same time, it actually also bears a lot more risk, right? And risk, as I mentioned before in my previous webinar as well, it's not just about losing money, right? It is also very much about the uncertainty of your investment outcome, all right? And this is very often overlooked or understated. So what you see here is a scenario where the blue line represents the ideal path towards your 1 million, which is your target. So it just steadily increases and hits there. Okay, then the orange lines out there, right, represent possible paths that can be taken by an investment in stocks. And as you can see here, they are fraught with a lot of swings. And some of these swings can be very violent, right? And there are a lot of uncertainties. So to put it simply, right, you can never be sure of your end outcome, right? So from a probability perspective, yes, you can possibly make a lot of money, like money that far exceeds your target, right? In fact, it can hit a lot more, okay? But the catch is this, right? You got to recognize that there is also the good chance that you can actually fall below your target and sometimes way below. And in that kind of situation, then it is going to have a very big impact on whatever plans you may have then. Okay, so let me illustrate this with a real world data, right? So this chart here shows you the outcome of a 20-year investment plan. And in this scenario, right, what you did is you invested $100,000 or $120,000, right, into global stocks at the start of a specific year. And after that, you just hold the investment for the next 20 years. Okay, your target is to grow it to $660,000, which is roughly about 8.9% per year. Okay, and why 8.9%, right? You might ask, because that is roughly the average yearly performance of global stock markets between 1970 to 2020. Okay, so the value you plotted over here, right, on this blue line shows you what you're going to have after 20 years. So if I start, let's say, in the year 1970, what I will have after 20 years will be slightly over $1 million here. Okay, and if I start in the year 1999, what I would have after 20 years is only $231,000. So as you can see from here, right, the range or the variation in the outcome is actually huge, right? Anywhere from $231,000 to as high as $1.5 million. Okay, so your chance of actually missing your target of $660,000 is actually not small. Okay, about 50% of the outcomes here actually misses your target. And the average shortfall, meaning how much you're off from the target, is also not small as well. Okay, the average is about 45%, with a maximum going as high as 65%. So a shortfall of 65% actually means that you hit only 1/3 of your target. Okay, and that could have a very serious impact on your plans later on. All right, but the good news is that we don't have to leave everything to chance if we do have a proper plan and strategy. Okay, so this session, what I've introduced to you is the all-weather strategy, and all-weather strategy will help you construct a portfolio that is a lot more resilient, it is low in risk, and it produces what we call stable and decent return profile. So with an all-weather, right, instead of the highly volatile and risky paths which you see earlier, right, in a pure stock investment, their possible paths are a lot less volatile. So such portfolios tend to move a lot more steadily with less fluctuations. So yes, you are not going to get like outliers that are going to far exceed your expectations, but on the positive side, you are also a lot less likely, right, to get outcomes that are way below the target that you set. Okay, now going back to the very first question I made now, if given a choice now, how would you want to grow your wealth? Right? Would you want a path that is fraught with like risk and uncertainty of not knowing where you might actually end up? Or would you choose an option that can let you sleep a lot more peacefully at night? Okay, I believe the choice is a simple one, and most of us is going to lean towards the second option. Okay, now the question here is, how do we build an all-weather portfolio? And the answer is actually very simple. It is your good old diversification, or just simply don't put all your eggs in a single basket. Now, why diversify, right? You might ask. Very simple. Just ask yourself these two questions. First, can you control, right, how the market is going to move? No. Okay, answer is very clear, because unless you're the central bank or some big shot like Donald Trump, Jerome Powell, Ben Bernanke, or Elon Musk, right? You're not going to move the market with what you say or what you do, right? And the second question is, can you predict, right, how market or each asset is going to perform, right, in the future? Again, the answer is clearly a no, right? No one can predict the markets to any consistent degree. That is why you often get those famous people who predict the market crash. Then if you follow them, you will see that they almost always fail, right, to predict the next one. Okay, so the best line of defense as well as offense, right, is to diversify your portfolio across a good mix of different assets. Okay, so many successful professionals, right, actually also subscribe to the idea and also uses diversification extensively, in particularly within the hedge fund industry itself. And what we have here, right, are quotes that are taken from established giants within the academic and hedge fund industry. So Harry Markowitz, right, the first guy that you see up there, right, actually came up, he's the person that came up with the modern portfolio theory back in the 1950s. Okay, and it says this, all right, diversification is the only free lunch in finance. But in fact, with all the innovations like ETFs and lower cost of trading, well, this is also implementable and within reach for retail investing as well today. Okay, then you have Ray Dalio, right, the second guy, who is from Bridgewater Associates, one of the largest hedge fund in the world. Okay, he's the founder of that hedge fund. And he says this, so if you cannot predict the future with much certainty, and you don't know which economic conditions will unfold, then it seems reasonable to hold a mix of assets that can perform well right across different market conditions. Okay, so he, as the veteran expert, also recognizes that it is impossible to predict future market conditions consistently. Okay, so the two of them are kind of related to each other. I don't know whether they personally know each other, but what they do are related, because Harry Markowitz's modern portfolio theory, right, is what gave birth to the concept of an all-weather portfolio. And Ray Dalio, he is the pioneer who is instrumental in putting that concept, right, into commercial practice. And what it did was he launched an all-weather fund in 1996, and today the fund, right, has more than $50 billion under management. Now, you don't run a fund that long and grow it to that kind of size if the fund strategy and principle doesn't work. All right. Okay, then why do some people actually think that diversification doesn't work? Or some may even think that they're outright useless, right, because they dilute the return. Okay, that is largely because they are not doing it the right way. Okay, they don't know how to go about diversifying, or they are also not looking at diversification from the correct perspective. So more often than not, they're just looking purely at returns and are totally like oblivious to the risk. So they are missing out on the whole picture, right? Because they're looking only at half the thing, right? Now, if you know how to diversify correctly, you can actually still achieve comparable returns to the stock markets or even higher, right? And you can also do that, right, using significantly less risk. Oh, but how should we diversify, right? To answer that, you need to question yourself or need to ask yourself these two questions, right? Well, the first question is, how do you choose your assets, right? To construct a portfolio, right? You need to select the components that you want to put inside, right? So that is the first question. Then after selecting the assets that you want inside your portfolio, the next natural question to follow up then is, how then do you allocate, right, your capital across all these assets? Make sense? Okay, and I can tell you that the answers revolve around this thing called balance. So what we want here, right, is a balanced mix of assets that can help you adequately navigate different market conditions, and also a balanced allocation across these assets, such that we have the best chance to survive through all the harsh market conditions. And when you have both in place, right, that is where you get an all-weather portfolio. Okay, but do note that all-weather is just a name coined by the industry, right? It doesn't necessarily mean the portfolio is invincible. It is still going to have its up and down. It's still going to have its own share of strengths and weaknesses. So it is the same with any type of strategies that you're going to run. But it is definitely a lot more robust and resilient than your traditional or typical portfolios. Okay. Now let's tackle the first question first, basically your choice of assets. Now, stocks is by far, I think, the most popular and widely used asset class among retail investors, and for good reasons, which I mentioned just now, right? They are easily accessible. There are plenty of information about them. They give good returns, and people can understand this asset class easily. So many people stick almost entirely just to stocks when they construct their portfolios. And even when they do diversify, they're still doing it within stocks itself, right? But they may kind of spread it out over stocks in different sectors. But how much diversification can we actually get out of this? So yes, you can probably kind of reduce the risk of adverse company-specific events, right, that happen to, say, one or two of your stocks, so that you don't get hit too badly when it happened. But on a broader economic level or larger scale, right, such diversification will offer you the limited benefits, right? Because when a bear market or a stock market crisis comes along, you can be sure that almost all your stocks, well, if not all, they're all going to hit in the same direction, and that is down. And from this chart here, you can see how each sector performed during the dot-com crash in 2000 to 2002, right? So from the more conservative consumer staple sector all the way to the riskier tech sector, every sector is down, right? It is just a matter of how much, right, they're actually down. Okay, the same happens for the great financial crisis in 08 and 09. Again, every sector is down, right? Anywhere from -30 to -80%. But except that in this period, financials actually took the lead in terms of the largest hit. Now, would this be any better if, let's say, I diversify my stocks across different countries? Okay, the outcome actually is not any different. All right. So whether you're invested in stocks in, let's say, US, UK, Singapore, Japan, Germany, Australia, they all headed south, right? Between anywhere from -30 to 60%. And that's for the dot-com crash. And unsurprisingly, of course, during the great financial crisis, you can expect the same thing to happen, right? They crash between -50 to 60%. So to put it simply across, right? If you're only vested with stocks, then you have nowhere to hide when such a crisis hit. So your portfolio is only going to go down, and it can potentially go down a lot. So for your information, the US S&P 500 actually lost close to 90% during the Great Depression, right, in the 1920s. And is that going to repeat, right? We don't know, right? But this is something, or this is definitely a situation that we would not want to be in when all we hold are just stocks. All right. Now, stocks generally head in the same direction. So this concept is what we call being highly positively correlated to each other. So more and more of the same thing, or more and more stocks, is going to offer you little diversification benefits. So what we actually need here are assets that are lowly correlated or negatively correlated with each other. So these assets have fundamentally different behaviors from each other. And as a result, When one asset goes down, another may actually go up and offset some of the losses, or even allow you to make some gains in the process. Okay, so this little diagram here kind of illustrates the concept. So it's a bit of an ideal case, but it's just meant to get the message across. So what we have here is two negatively correlated assets in the portfolio. So both, as you can see from here, they trended up over time. But so when B goes down, right, A goes up, okay? And when A comes down, B goes up. So they kind of cover for each other and complement each other very well. So the end result, right, is a portfolio that just goes up steadily over time, which is represented by this dotted line over here, right? So picking the right asset can actually help you reduce the overall risk of your portfolio immensely and help you achieve a stable ride up, right, towards your target. So now the question here then is, what other kinds of assets can we actually choose to complement stocks, right? Now, one of the best options here is something that you all are probably familiar with or have seen before, and that is bonds. But not just any type of bonds. Okay, for example, junk bonds are not going to help much, right? Because when a crisis hit, the default risks are going to rise and people are going to dump those bonds as well. So a much better option are government bonds with high credit ratings, such as the US Treasuries. And you'll find many asset allocation products out there that pairing stocks with bonds. And a good percentage of those bonds are actually usually allocated to government bonds. And there are good reasons behind it, right? It's not just because bonds are conservative or lower risk. So now let's try to understand why. Okay, the main reason is because bonds are historically negatively correlated with stocks. So the bar chart here kind of shows you how the S&P 500 and the US Treasuries performed during some of the key major market crises. Right, so during the crisis period where S&P 500 lost significant amount of money, you can see that the bonds actually delivered positive performance here. Right, for example, during the great financial crisis in 08-09, the US Treasury gained 17%, all right? While the S&P 500 lost more than 50%. Then in the more recent, like the COVID-19 pandemic in 2020, US Treasury is up 7% at the end of the period, right? While the S&P 500 actually lose like 20% over the same period. And now if you zoom in, right, into this table down here, so when S&P 500 is actually down for the month, less than 0%, right, there's a 64% chance that Treasury bonds is up for that particular month. And on average, right, Treasuries actually delivered 1.1% during those months. Now, the worse the S&P 500 performs, well, the better the Treasuries did actually. So when S&P 500, for example, is down like more than 5%, well, in a really, really bad case, okay, for that particular month, then there is a 75% chance now that Treasuries actually is up for that particular month. And on average, it did even better. It did 2.1%, right, during those months itself. So you can see from here, right, we pick Treasuries not just because it is simply a safe or conservative asset, but also because it is negatively correlated with stocks. And because of that, it can act as an effective and reliable hedge, right, to protect the portfolio, right, in times of extreme stress. And there are good reasons for the behavior, right? When crisis hit, what happens? Investors will tend to pull their funds out of risky assets such as stocks. And where are they going to park those money? They're going to put it with safe haven assets such as US Treasuries. All right. And central banks are also going to move in to ease the monetary policy during tough periods by lowering rates and providing more liquidity. So this tend to favor bonds, right, and lead to bond price rising during such times. Now, of course, this is not 100% certainty. There are also situations where both stocks and bonds can rise and fall together as well. But by and large, right, this is the main reason why stocks and bonds are such a good pair. All right. Now, you don't actually have to restrict yourself to just two assets. All right. The financial market is actually much bigger than that. And there are other asset classes that you can actually tap on to construct your portfolio, right? So for example, besides stocks and bonds, you can also look into commodities, there are also real estate and currencies. Okay, but due to time limit of this webinar today, I'm not going to delve into all this. This just to give you a sense of like what other stuffs are actually out there. All right. Okay, what I want to move on next, right, is to address the second question in building the all-weather portfolio. Now, how much capital do we allocate to each asset in our portfolio? And to simplify the illustration, right, I'm just going to make use of the two asset portfolio comprising again just purely of stocks and bonds. Okay. Now, for the longest time, right, this is what people do, or what we have been advocated to do by professionals as well. So like, for example, based on our risk preference, we may be asked to allocate a fixed percentage of our capital into stocks and then the remaining into bonds. So let's say if I'm young and aggressive, then a possible allocation might be like 80% stocks or 20% bonds. Or we just simply refer to that as 80-20. Okay. Or if I'm more conservative, then a possible recommendation might be the very common 60-40 or the equal weighted 50-50. So these traditional methods of doing things are what I call the fixed capital allocation solution. And why is it called that? It's pretty obvious, isn't it? Because they work based on fixed capital percentage allocation, right? And they're popular because they're very simple to understand, right? Which also kind of makes it easier to explain and sell. Okay, and they're also very easy to implement. However, that doesn't make them the best way to actually approach the markets, because these solutions are not balanced. All right, and let's see what we meant by that. Okay, suppose you allocate your capital equally to stocks and bonds. So let's say 50% stocks and 50% to bonds. So if you look from the perspective of capital, right, your portfolio is going to look entirely balanced, right? Because you have the same amount of stocks and bonds dollar-wise. But is it really balanced, right? The answer is actually no. Okay, because if you change your perspective and look at risk instead, the picture, right, is totally different. Dollar for dollar, stocks as an asset class is inherently a lot riskier than bonds. So the stocks in your portfolio, right, is going to hold a lot more risk than bonds. And risk, right, is actually what drives the returns. So your portfolio is largely going to be driven by stocks. So in fact, right, in a typical 50-50 portfolio, right, it has been proven or calculated that stocks do account for like near to 80% of the overall risk, right, in your portfolio itself. So what we really want here, right, well, is not a balance in capital or your dollars, but rather a balance in risk. All right. Okay, and in the industry, right, such an allocation method is known as risk parity, right? And so we want each asset to drive and contribute to our portfolio equally, so that when a crisis actually hits one of them, we know the other, right, is still able or still capable of holding up. Okay. Okay, and because risk itself, right, is a dynamic parameter that is calculated based on market conditions. So to keep the risk of the different assets in your portfolio at the same level, so what we need to do is we have to rebalance our portfolio periodically. So this kind of makes the methodology also adaptive to changing market conditions. So let's say when the risk of the stocks actually go higher, we're going to size down our size on the stocks relative to the bonds. And should the risk of the bonds, let's say, goes higher, then we will size down the bonds relative to the stocks. So to illustrate this idea, let's have some generic scenarios here. Okay, so if let's say before you rebalance, right, the risk of the stocks is actually higher than the bonds, and this is usually the case, what we're going to do, right, is going to allocate less capital to stocks and more to bonds. All right. And the end result after rebalancing, right, is that the risk of both the stocks and bonds are going to be equal or the same as each other. All right. Now, in this second scenario, let's say if the risk of the stock is significantly higher than the bonds before rebalancing. For example, this could be like a stock crisis period where volatility of stocks is extremely high. Then what risk parity, right, is going to do is it's going to size down your stocks even more and size up the bonds more, right, relative to the stocks itself. And what is the end result? The end result is the same. What we want to achieve is equal risk between the stocks and the bonds. Now, what if, right, the risk of the bonds turn out to be higher than stocks before rebalancing? Okay, this is a rare situation here, but it might be the case that there might be some bond-specific turmoil or issues brewing. So in this case, then what risk parity is going to do is it's going to size up more or allocate more to stocks, right, relative to the bonds. And the end result of what it wants to achieve is the same throughout. It wants to keep the level of the risk between the stocks and the bonds the same. So that is how an all-weather or risk parity portfolio actually adapts to the different market conditions. Now, it is extremely difficult, right, for anyone to be able to predict consistently like when the market regime is going to change. Okay, we don't know when the bear is going to come. We don't know when the bull is going to come as well, right? But with an all-weather portfolio, we actually have no need to do so, right? Because what we're doing is we approach the market of balance, right? And the risk parity methodology adjusts itself, right, to the different market conditions. And by design, right, stocks and bonds actually have fundamentally different behaviors during different market cycles. So in a bull market, stocks are going to do better than bonds. So bonds are likely to lag behind. Now, but take note here, it doesn't mean that bonds are going to lose money during bull markets. Okay, bonds can also rise in the bull market. It is just that it is going to lag behind stocks. Okay, then in a bear market, right, of course, stocks is going to fare badly and bonds are likely going to rally and do much better than stocks. So it's because of this relationship between each other, right? And that is why even a simple two-asset portfolio, right, running on the all-weather or risk parity principle, what is capable of producing very decent risk-adjusted performance. Now let's take a look, right, at the rebalancing action of the two-asset risk parity at the end of every month in the year 2018. Okay, so in this example, right, I use the SPY ETF, okay, for stocks. So SPY ETF is the S&P 500 ETF. And for bonds, right, I use the IEF ETF. So IEF is the 10-year Treasury ETF. So I use these two ETF to construct an all-weather portfolio. So let's try to observe from here, right, how the allocation changes with the market. So the bar chart on the left here, like, represents the capital allocations to stocks and bonds at the start of each month. Okay, so the blue bar represents stocks. Okay, the blue bar represents stocks, and the brown bar represents bonds. And the line chart on the right hand side here, right, shows you the net asset value at the end of each month. Okay, so the stocks is the blue line and the bonds is the brown line. The all-weather portfolio is the green line. And I also included for reference purposes an equal-weighted portfolio, which is the dotted line. Okay, and the period I use here is 2018 because it is a fairly volatile year. So we can see more clearly like how the allocation actually changes with time, right? So we started here in January with a 60% allocation to bonds, okay, and about 40% allocation to stocks. So stocks actually underwent a euphoric but a volatile period in January. So as a result of that, the risk of stocks actually went up. And so at the start of February, right, the risk parity strategy actually sizes down stocks and sizes up the bonds, okay? And that turns out to be timely because the stock market actually crashed or came down in February itself. Okay, then continuing over into March, but the risk parity strategy continued to size down the capital to stocks even lower. Okay, and that turns out to be another good move, right? Because stocks continue, right, to hit south, right? And this time, bonds actually rose and helped to offset some of the losses. And because we hold a lot more bonds than stocks, our portfolio actually went up in March itself. Okay, then over the next few months, right, things sort of like settled down, right, and the stock market starts picking up. And we also gradually start to size the allocation to stocks back up. And this persisted like all the way until October. All right, so October, the market suddenly just crashed. And this was the period where we had the trade war between US and China going on, as well as the hawkish Federal Reserve was pressing down on the market back then. So our risk parity portfolio is actually also caught by that particular down move in that month, right? But right in November or at the start of November, it started adjusting down its allocations to stock dramatically down to just about around 15% of the portfolio. And it maintained that all the way right through December. Okay, and that was a good move, right? Because the stock markets actually experienced its worst month of 2018 in December itself. So on the other hand, right, as you can see from here, bonds actually enjoyed a good rally, right, during the last quarter of 2018 itself, right? So the right assets, right, with the right sizing actually allows the all-weather portfolio to actually kind of navigate through those very tough months itself. And at the end of the whole year, right, actually only bonds, right, and the risk parity portfolio or the all-weather portfolio is up. So even the equal weighted portfolio, right, which is represented by this dotted line, right, is down for the particular year. So overall, it was a very bad period for stocks. But the amazing thing is, despite having stocks, right, all-weather portfolio still managed to outperform bonds itself. Okay. Okay, now so far what I've been talking about is using two assets like stocks and bonds to build a risk parity portfolio. But you can actually extend the very same principle to more asset classes in order to get a better and more stable performance itself. So what I'm showing you here, right, in this slide is the model performance, right, of one of our all-weather strategy, which is constructed using multiple asset classes. Well, there are stocks, there are bonds, there are commodities, there are real estate, but within this portfolio itself. So with a very conservative, right, and slight use of leverage, where this portfolio can actually match the returns from a stock market, right? So you see the annual return here is 10.4% against S&P 500, which is also 10.4% over the same period from 2005 all the way to 2021. Okay, but the notable thing here, right, is that this all-weather strategy actually uses a lot less risk than the S&P 500 itself. So we have 8.9%, right, against 14.5% for S&P 500, right? So the all-weather portfolio is actually a lot more efficient, right, in terms of generating return. So we can say that for every 1% of risk taken, the all-weather portfolio actually gives you 1.16% returns. And that compares like favorably against S&P 500, which only gives you 0.71%, right, for every 1% risk taken. Right, and on top of that, right, the largest historical loss experienced over the period, right, is only 10.7% for the all-weather portfolio against like more than 50% for the S&P 500. So if you look down at this net asset value lines over here, right, and concentrate or zoom in on these two circled areas, right? The first one corresponds to the 2008 and 2009 great financial crisis. And then the next one is the COVID-19 pandemic sell-off in 2020. And you can see that during both of these periods, the all-weather strategy actually fared, right, a lot better than the S&P 500 itself. Right? In fact, it actually made some money during these two tough periods itself. So the thing is, if you know how to diversify, right, and how to construct a portfolio, you can actually have a lot more scope to play around with, and you can actually have a much more smoother journey, right? And at the same time, without necessarily compromising on the returns that you want to achieve or what you can get out of it. Okay. All right, so with that, I sort of like come to the end of what I wanted to share for today's topic. So I hope you have a better idea of what an all strategy is now, what are the key considerations that you need to think of, the assets to put in, and you have some idea why we are allocating by risk instead of by capital, and what are the benefits of like allocation using risk instead of using capital. Okay. So, and for your information, this all-weather strategy is actually one of the strategies that we run in our multi-strategy portfolio. So within this multi-strategy portfolio, we actually uses multiple advanced strategies and apply them across like different asset class, different markets, and different geographical locations. So this can actually help you achieve an even more extensive diversification and better results, than the all-weather portfolio alone. Okay, so and if you're interested, right, actually this portfolio or this multi-strategy portfolio can be implemented with the help of our iFAST global advisors, Dawei and Bernard. So this is our current arrangement of them. And over the upcoming webinars, we're also going to share more on this service as well. But if you want to know like more in-depth information about it now, like through a one-on-one discussion, so what you can do is to scan this QR code, which you see here, fill up a simple form, and Dawei will be getting in touch with you. Okay. All right, so I believe it is now time for the quiz, as usual at the end of every webinar. So it is a very simple quiz, not to worry about it. It is just two simple multiple choice questions, which you can do in probably less than 2 minutes. So you can trust me on that. All right, and every answer that you get correct is going to help you to increase your chance in winning the lucky draw on the 2nd of October, right, which marks the end of our quantitative investing festival. Okay, so all the best. And what I'm going to do now is I'm going to hand things over to Dawei for him to administer the quiz. And I will see you back in the Q&A session after that. Okay, back to you, Dawei.
Okay, thanks, Ying-Guan, for the very educational and wonderful sharing. I do think that the theories and the strategies that we have gone through, they are really very crucial and very important for us to understand what quantitative investing is about. and especially when it comes to running a multi-strategy portfolio or the portfolio that is based off a strategy from hedge funds. Okay, so one very interesting thing that we also realize and also note is that although the all-weather strategy by itself, right, with some slight leverage, right, it may be able to match, right, and it was able to match that return from the S&P 500, like how Ing-Wan has mentioned just now, right. At the same time, right, the multi-strategy portfolio, which has just the all-weather strategy as one of its internal strategies. Right? This multi-strategy portfolio is able to increase our risk return ratio and make it even better. And even without that leverage, we are able to see that return being able to match or even beating our global stock market indices and our S&P 500. Okay, so this is really something that we are looking forward to share with you guys this coming Saturday. Right. So today's session is more about that basic strategy and idea behind how the multi-strategy actually works. Okay, so yes, as promised before every session, we're going to have a short quiz, right? And I do remember that some of you guys, there was a question coming from you guys asking about the volatility topic last week. Right? So I remember one very important question, right? And that question was actually, how do we know when to enter and exit volatility ETFs? Okay, so well, this answer is actually found in Allcoin's mega package by itself. Right? So if you are our prize winner for our quizzes and our lucky draw, we are going to wish you a big congratulations, because you are going to know how to protect your portfolio and your investments very well during times of market crisis. Okay, so without further ado, right, let's go straight into the quiz, and let me just bring it up for everyone. Okay, so here's the quiz, right? Please bring out your mobile phones and scan the QR code to enter the quiz, or you can also go to ahaslides.com/7004Q. Okay. So let's give ourselves some time for everyone to come in. Okay, we're going to start soon. Let's give it another 10 seconds or so. The link to the quiz is still on top of the screen. So if you are not able to scan the QR code, since I'm not showing it anymore, and we are proceeding on, you can still go to ahaslides.com and key in that link up there. Okay. So there are 2 MCQ questions. They are very simple. And each question we have 60 seconds for it. Okay. All right. So for the lucky draw, we will need your help to provide the last 4 characters of your NRIC, or if you're not from Singapore, your passport number. Okay, and also your name and your email address. And once you're ready, please press join. Okay, and we are going to start. now. Okay, let's go. First question. What is the central theme behind the all-weather strategy? So a very simple question. We always say that there is one free lunch in the world of investing. Right? What is that free lunch? Do we need to concentrate a lot and try to figure out what is our risk? Looks like everyone has answered. Great. Right. So yes, the answer is diversification and balance. Right? This is exactly the free lunch that we might as well all take because it is truly free and there for us to reduce our risk for every level of return potential we are looking for. Okay. So let's go on to the second question. What are the key questions that you need to address in the all-weather strategy? Right. So please look at your phones. The options are over there. So do you need to try to choose the assets? Right? How do you allocate capital across assets? Is this a question that you need to ask yourself? Do we need to try to predict market regime changes? And do we really need to try to select the best stocks to buy at any moment in time? Okay, 15 seconds left. Three seconds. Okay, time's up. What's the answer? The answer is A and B. Okay, so the questions that we need to ask ourselves are how do we choose the assets? Right? How should we choose assets? And how should we allocate our capital across the assets? Okay, so thanks everyone for participating. And that's all for the quiz. We will be announcing the winners at the end of the festival on 2nd of October. Okay, so thank you. And let me switch back to the slides for Q&A. We do see the number of questions coming in. So maybe you can go ahead and start with the first question that I see. So the first question is, how long a historic risk do you consider before deciding that risk profile has changed? Maybe Ingwen or Patrick, you want to come and answer this?
Yeah, okay. I can try to understand. I believe you're trying to ask like, what is the window period where you try to like calculate or determine the risk level of the different assets? Okay, it isn't exactly like whether the risk profile change or not change, because the risk is always being updated every single time, like every day is going to change. So what risk parity essentially do is to measure the amount of risk of each asset class. Okay, so it isn't like, oh, like a switching process, no, like, oh, now risk is now more risky than stocks, then after that stocks is more risky than bonds. It doesn't work that way. Okay, so most of the time you can expect that the risk level of stocks is going to be higher than that of bonds. Okay, but they are going to vary in terms of the whatever you call it, the strength. All right, so the risk level of stocks is going to change day in, day out according to how the market fluctuates. The same thing is going to go with the bonds. Okay, and their correlation is also going to change right over time as well. So this is what we take into account when we try to kind of compare the risk of these two assets right within the portfolio itself, right? And we use that to kind of size up the portfolio. All right. So I don't know whether that kind of answers or addresses your question, right? So I think most of you have this very basic or fundamental idea in terms of thinking that, oh, it's a switching process. So now if stocks is more risky, then I'm going to switch to bonds. And if bonds is more risky, then I'm going to switch over to stocks. So the thing with risk parity or all-weather strategy portfolio is you're almost always in both assets at the same time. And what you vary or what you change right over time is only the allocations across the stocks and bonds, but according to what the risk level of these two assets, right, is telling you, right, at any point in time. Okay. Yeah.
Maybe just to add on to what Eng Guan have said. So when we want to calculate things like what is the volatility or the correlation between the asset classes, right? So obviously we will need a certain window period to calculate these parameters. So then the question comes down to how long a window period should we use to calculate these parameters? Now, there is no right or wrong answer. So the question really boils down to trade-off, right? How sensitive do you want your model to be? So if you want your model to be more sensitive, right? So obviously you want a shorter window, but the problem with this is that if your model is too sensitive, then you might end up with getting a lot of whipsaws, right? So like risk can keep on fluctuating around and then you keep on adjusting your portfolio. Then on the other hand, if you use a very long window period, then your sensitivity to the risk parameters will not be as strong. So then you will find that your allocation to the asset classes actually does not change that much over time. So again, it boils down to the question of how sensitive does your model, or rather how sensitive do you want your model to be? Okay, like I said, there's no right or wrong answer. So I think it's really a matter of true experience. Then you decide, okay, what is the right window period that you want to use? Okay, that's all.
Okay, thanks, Eng Guan, Patrick. Let's move on to the next question. Okay, this question is directed at Eng Guan. Eng Guan, you mentioned about risk. We know, how do you measure this risk?
Okay. Okay, the risk, right, is measured using this measure. Okay, if you do a search on the internet, you'll be able to find it. It's called marginal risk contribution. Okay, so within marginal risk contribution is the breakdown of the different risk level by your assets, right, within your portfolio itself. So there are two main things that is there are a few things that is dependent on, right? Marginal risk contribution is determined by your allocation to the asset, right, which is what you're trying to determine. But the second thing is the volatility of the individual assets itself. Okay, and the third and the last thing is the correlation, well, between the assets inside your portfolio, right? And for the two asset portfolio, which I showed you just now, I think there's only just one correlation. So the correlation between stocks and bonds is the same as that of bonds with stocks. Okay, so that one is a very simplified case. But when you have more asset class in play within the portfolio, then the correlation do matters and it plays an important role. All right, I hope I answered your question.
Okay, thanks, Eng Guan. Let's go on to the next question. I do see a very important question. Maybe Patrick can come in to help us with this. So this question is asking, after implementing the model, how do we know that the model is no longer working in the future? Very good question.
Yes, indeed, this is a very good question. And this is something that I think a lot of quantitative investors have to struggle with, because I mean, ultimately, there are, like statistical measures that we can use to kind of measure the performance of the model going forward to see whether has it actually violated any of the past performance statistics that we have seen before. So a very good example is, for example, if based on our simulation, right, the maximum drawdown of the model never exceeded like maybe more than 20%. So if like going forward, then the drawdown hits maybe like say 25%, then the question is, should we dump the model and say, yes, it's no longer working? Now, there is no easy answer to this, because the fact is that, whatever simulation you do, right, it is always over a certain fixed number of years, right, a certain fixed period. So there could very well be market environments that you have not seen before during the simulation period. Okay, but that doesn't invalidate the model, because there's another element to the strategy, right, which is a qualitative aspect. So you have to examine and question yourself, like, does the qualitative premise of the strategy still hold, right? So for example, when we talk about the all-weather strategy that Eng Guan has just shared, right, the premise is that asset classes, okay, they will be non-correlated non-correlated to each other over time. So the question is, will this remain true going forward, or do you think that not now going forward, right, all the assets will be moving in lockstep all the time? Okay, so the qualitative aspect is something that's more difficult to really give a definitive answer. So one of the ways in which quantitative investors try to overcome this problem, right, is to run multiple models. Okay, so when you have multiple models in your portfolio, then you have more leeway, okay, to give your independent strategies, right, more leeway to kind of in a way like maybe flout your historical characteristics, right, and say that, okay, I'll give it more leg room to run and see how it develops going forward. Because even if the model continues to underperform, right, the overall hit to your portfolio will not be that severe. Okay, Ingwan, do you have anything else to add?
Yep, no, not really. So maybe you can proceed to the next question.
So maybe let me come in and elaborate a little bit as well, as I actually cover a little bit of the qualitative aspect of investing in one of our sessions. Okay, so I did mention before also that every model, it works based on a fundamental reasoning and logic, right? So if your model is going to work on an area of the investment world, say for example, if we are going to work on the technology sector, right, and your whole model is based on this technology sector, and you're going to run your ETFs and your stocks, if you're using stocks, based on this sector itself, then one very important thing to consider is today our technology sector, it is made up of a few big tech firms, right, a few giants. Right? What if in the future, right, these giants, they are no longer around? Right? What if the situation in the future is going to be different? Right? And so this is where we have to go back and examine that fundamental logic behind your reasoning. Right? If in your model you assume that, okay, our big tech firms, they are going to be here for a while, right? And why are they going to be here for a while? Are they going to keep doing their business and then keep staying competitive, right? If they are, then my model works, right? And then it's reasonable. Right? But if today the situation is changing, right? This is not to say that your model is definitely going wrong, right? But it's definitely high time to come back and think about whether there were any assumptions that may be going to be violated, right? Maybe in a few months' time, in a few years' time, or maybe you can't even put any fixed timeline to it. But we know that that basis of reasoning behind our models, they are getting weaker and weaker. Right? And so this is time when we need to be careful and need to consider whether our models are still relevant. Okay. So let's move on to the next question. Okay. This question is asked by Ping Leong again. Just now, Ping Leong actually asked the question to Ingwan about risk parity, right? So to answer your second question, in the long run, since markets are predominantly bullish, right? So Ping Leong is asking, granted that we have higher return per unit risk, but in terms of absolute returns over the long run, wouldn't pure equities still outperform the market and outperform a more hedged version with bonds inclusive?
Okay, maybe I can take this question. So I mentioned before during the presentation that running things at a lower risk doesn't necessarily have to compromise on the returns itself. Okay, so it can be done that you can get a higher risk-adjusted returns and yet still outperform your stock markets in general. And I've actually shared something during my student sharing session earlier with like NTU and SUSS, where I also briefly touched on this point. I basically kind of like showed them the performance of the hedge funds, right, versus the global stock market, like since the 1990. Okay, I'm just gonna pull out this slide here and let you see, so you can get a better idea. So Tao, I'm gonna share screen now.
Yeah, sure.
Okay. Okay. So this is a particular slide that I shared during the student sharing session. Okay, the blue line here represents like the aggregate performance of the hedge funds since 1990, right? Because that's the earliest you can get hold of hedge fund data. And then the orange line is that of the world stock market, which is using the MSCI World Index. And then the gray line is our Singapore market. So as you can see from here, right, the hedge funds actually delivered an overall higher return of 9.6% over the entire period itself, right? And that's higher than the world stock market, which only did like 7.15%, and Singapore stock market, which did like 6.31%. And it does so, or hedge funds does so, using at the same time a much lower risk. So it has an overall Sharpe ratio of 1.41. That means it returns you like 1.41% for every 1% risk taken, which is much higher than both stock markets illustrated here. So it is not true that if you have higher risk-adjusted returns, then you are sacrificing that you're actually sacrificing your returns to achieve a lower risk. All right. If you know, there are many ways to diversify. I think the most common ways that you're exposed to tends to be like your 60-40 and 50-50. So when you diversify in that traditional way, without any other strategies to kind of assist you, then that is a reasonable assumption, right? Because most of the time your returns are going to be average out between the two asset classes. Okay, but there are a lot more strategies out there than just your asset allocation, and you don't have to restrict yourself just to stocks and bonds as well, as I mentioned earlier. So if you know how to do it, right, your scope is a lot wider and you can achieve a lot as well. Yeah, okay. So let me unshare my screen.
Okay, we are overrunning by a bit, but let's just take two last questions. Okay. So the first question is, what are the chances that bonds will be correlated to stocks in the future and break the strategy? And for bond funds, they can also be panic sold. Right? So how do we prevent that and protect our portfolio?
Okay, maybe I can take this question. So yes, in fact, a lot of talk in the market about, in this current low interest rate environment, right? How much more room do bonds have in terms of the upside? So this is where one of the characteristics of fixed income assets, right, especially pertaining to government bonds, is not very well understood, right? And this characteristic is that in the event of, like a huge, risk-off environment where there's a lot of fear and panic in the market, right? A lot of institutions will flock to the safe haven assets. And as it is now, right, even the government bonds around the world, despite the fact that they're having very low interest rates, and in fact, some of them are even having negative interest rates right now, these are still considered as safe haven assets. And money will still continue to flock there in the event of a liquidity event. So for example, if let's say there's a very basically in the tail risk event, a sudden unexpected event happens, you can expect that money will flow sharply and quickly into this government bond assets. And in fact, one of the example can be clearly seen yesterday. So yesterday, right, what happened was that the US S&P index actually dropped 1.7%, okay, in a single night. And what happened is that the long-term government treasury ETF, right, actually went up by 1.24%. Okay, so you can see that there is this very good offsetting effect that you can find from the bonds against your equity risk. Now, of course, the question is, are we guaranteed to continue to have this kind of behavior going forward? The thing is, like what I mentioned, right, I still think that government bonds are still considered one of the safest haven assets out there, simply because of the guarantee backing these assets by the government. But having said that, right, yes, as Ingwa has mentioned earlier, there are chances that both asset classes can sell off at the same time, okay? And that is why, okay, I'm going to talk about it more in my upcoming webinar this Saturday. We do not, we usually do not advocate running a single quantitative strategy for your portfolio, because you're really exposing yourself to just one single strategy, right? The risk and return driver of one single strategy. A better approach would be to diversify across multiple strategies. In that way, right, the different pitfalls of different strategies can be offset by the other strategies. Okay, so I'll talk more about this during Saturday's session. Thank you.
Maybe I'll just share something on the correlation part, because I've written an article on it before, so I'm going to share screen again.
Sure, Ingwan.
Okay, let me share my screen. Where is it? Oh, where is it? Okay, share. Okay, you can see this particular chart here down here, right? So this is the 6-month rolling correlations between SPY and IEF. So as you can see, right, the correlations is not a constant thing, right? Just like risk correlations is also a dynamic parameter that can vary and fluctuate over time. And between the 6 months correlation between stocks and bonds can actually vary anywhere between near -0.8 to as high as more than 0.2. All right. So you will see periods where the correlation actually rises over time, where it rises rapidly, very high up to like 0.2, right? Just like where we are now. Yes, the stocks and bonds correlations have been rising in the short term over time, and it's now more than 0. But if you look at the absolute value, it's still very low. The 6 months correlation is still like 0.05. Okay. And is this the first time that correlations have risen? No, right? It's littered throughout the entire history. Okay, that you can see that correlations rises between stocks and bond can rise all the time, right? Depending on the situations that can happen, right? And okay, so it's littered with high correlations. So these are the two periods which I highlighted between 2013 and 2015, where stocks are during the taper tantrum that happens. So you have the correlation between stocks and bonds actually tightening or increasing. So they tend to kind of falls together during those times. But it can also, both stocks and bonds, like what I said earlier on, right, can also rise together. For example, during quantitative easing, right, when the US Federal Reserve starts to pump up a lot of money and try to cut the interest rate. So these are things that are going to be beneficial to both stocks and bonds, and you will be able to see them rising both together at the same time, right? Then on the flip side of things, if let's say we have a sudden surge of inflation or we have hyperinflation, then that's going to be negative for both stocks and bonds. And you can expect both of them to fall together. So everything has a reasoning behind them, right? And it is a part and parcel of how the market dynamics work itself out. And the risk parity strategy, of course, will try to balance out the risk as best as it can, and then try to adapt to the market conditions itself. Yeah, okay. Let me unshare.
Okay, thanks, Ingwan. We just have a very simple last question. Right? So the question came in asking if we are keen on running a strategy, right, that is all weather. Can it be done by ourselves? Or if we are keen to run a multi-strategy portfolio, how do we go about exploring? You guys want to come in and mention the QR code over here?
Okay, let me answer that also, right? So yes, okay, technically, yes, you can, all right? In fact, all the strategies that we have showed during all these webinars, right, they are adapted for retail investing. Okay, but of course, if you want to do it yourself, then you will need a theoretical and an operation knowledge to be able to run such a strategy. Of course, you can learn it, but depending on your foundation and experience, of course, there will be some learning curve involved. Okay, and the more important thing is after learning and building the model, do you yourself, right, have the faith, time, and discipline to actually run the operations consistently, and stick to the model, right? So that will be entirely another different story. And I know a lot of people have challenged doing that. Okay, so another option to do it, or the easier way to do it, is to engage like the service of a professional to help you or assist you, right, in the implementation itself. So currently we have the working arrangement with Dawei and Bernard from iFast Global Markets, and they are able to kind of help you run our more advanced strategies itself. So if you're interested to know more, you can reach out to us by filling out a form. I've shown the QR code earlier. Oh, okay, I think Dawei has already shown the QR code here right on this particular site, as on the right-hand side of it. All right, so if you're interested, then just scan this QR code, fill up the form, and let us know. And Dawei will get in touch with you shortly. All right.
Okay, so we have overrun quite a bit, right? But also due to the influx of questions, we're happy to have been able to answer all of them, right, or almost all of them, because I still see a number coming in. But thank you nevertheless so much for freeing up your time this evening and joining us. Right? And in the next session on Thursday, I will be sharing with everyone how, as a new investor, how can we really go about creating more consistency in our profits. Okay, so that's all for today. Thank you for coming, and I will see you on Thursday and subsequently on Saturday as well. Okay, thank you. That's all. Bye-bye.